Welcome everybody to All-Star Quarterly Review, third quarter 2015 webinar entitled Market Corrects Creates Opportunity. So those market corrections, obviously we knew were coming. The only way that you can buy low and sell high is to basically have money. And the opportunity, we believe, is right there in front of you. Welcome to John Shevlin and Michelle Lentz. John is a ex-linebacker for the University of Minnesota, played high school football with my son, captained the Gophers team. Michelle, I can't believe we hired a Badger, but she's an awesome young lady that majored in the CFP designation actually at University of Wisconsin. So I want to welcome them. More information is going to be coming in our blog soon. Market overview, real quickly, we want to talk about the correction is overdue. Was it overdone? I think that may have been, it may not have been, but we took a 15% cash position back in late 2013, early 2014, knowing that we hadn't had a correction for a long time, and that average corrections were somewhere in that 14% a year range since 1980. The events that eventually drove us over that line and basically from the peak in May 26th to that end of the August downturn was really oil prices continued to drop. We saw China's stock market go up 150% and then peak and lose 50%. And the Federal Reserve's rate decision was kind of an indecision for a period of time there that created some angst. All being said, market overview, when we see these things happening, we see slower growth worldwide. U.S. is trying its best. It's done quantitative easing 1, 2, and 3. A little bit of an albatross around our neck right now. Europe is trying the same thing. They're in the early stages of recovery and the early stages of quantitative easing. China is changing and maturing to more of a self-sufficient economy. So from an overall market overview, that might have some change and reflection and change. Quantitative easing in Europe, as I talked about, it's still early. PE ratios are really, really cheap overseas right now. So when we look at the U.S. economy, we look at jobs as the big factor here right now. We see the GDP in the second quarter was 3.9 or 3. What does it say? 3.9. Yep. Third quarter estimate is about 1.8. So it's about half of that. We'll see what the eventual percentage is there, but more importantly, jobs are really going to drive us in the positive or the negative, as far as I'm concerned. And we have 3 million added in the last 12 months, which is positive. Unemployment rate is fallen to 5.1, which is positive. However, that's a little misleading because we have a lot of people that have taken themselves out of the defined workplace. And that requires, to get full employment in the U.S., we have 5.75 million job openings, which kind of scares me on the service side of the equation, because typically the U.S. economy has about 5% unemployment. So when you have 5.1, you're probably the lower tier jobs are not being fulfilled by very qualified people. Consumers, on the consumer side for the economy, we can see their income was up 4.3%. Their personal savings was up even more. So they're going less into debt, which is good. They actually save some money. And consumer spending at 3.1%. We're going to see the holiday season is going to really be the telltale there. Businesses on the economic side are the large caps are being hurt with their export growth because of the valuation of the dollar. They're spending less, and good benefit for them, though, is that inflation staying low, the cost of doing business. So looking ahead on the economy, we still see the jobs as setting the table for growth. 70% of our GDP is really consumer spending. We have the holiday season coming up, which is going to be very important. The housing sector has been strong, fueled by low interest rates on the mortgages. We think that that will continue. And the younger American buyers, we're just seeing in the last 12 months, some of the group of people in that 25 to 30 age starting to buy more homes rather than renting. Inflation will stay low. which will be a direct reflection of oil rates being low and wage inflation not affecting us a whole heck of a lot right now. And we don't think that we're going to see a rebound for oil prices until later in 2016, which we believe will be a positive to the market and the economy. Bond market, let's talk a little bit about bonds. We've had, since interest rates have bottomed over the last 5 years, we've seen interest rates go up and down every other quarter. We see the Fed interest rates stayed stable and the overnight rates somewhere between 0 to 0.25. The 10-year Treasury fluctuated down just slightly. So when interest rates go down, bonds go up. Big benefactor of that was the U.S. government bonds. They rebounded from a negative. The 30-year Treasury was down negative 8% last quarter, positive 1.7 this quarter. Government agencies 1.0, municipal bonds, which are also government agencies, 1.7. The credit bonds, the corporate bonds, were really the ones to get hurt, negative 0.5, and the high yields even more at a negative 4.5 because of a lot of high yield bonds were issued to the energy side of the field in the sector. Foreign bonds got hurt also with the risk off and risk aversion mentality. Emerging market bonds were down about 2%, which created the global bond index, Barclays Global Bond Index, combination of domestic and international, positive 0.8%. When we look at the market going forward, we really believe, as we said, that interest rates will stay low. They really can't raise interest rates until probably later in 2016. We see a continued demand for our treasuries, which will be good. It'll keep interest rates even lower on that side of the equation, as most interest rates in foreign countries are lower than ours right now. So our interest rates look attractive to them. Corporate bonds, we think that they've obviously gotten hurt because of the potential energy defaults. I think we'll see some of that come through this next quarter. Earning in the emerging markets, again, they're the best reward, but the biggest risk kind of going forward. And you want to stay low duration still because, again, we don't know clearly how much interest rates may go up. When we talk about equities in the domestic stock market, it's the market correction overdue and perhaps overdone was a title. The U.S. weathered the storm better. So when we look at the U.S. downturn compared to the international downturn, we're talking about a range of the broad market index of Russell 3000, 7.3, negative 5.9, negative 8.9, negative 6.8 on large caps, small caps, negative 11. But look at the international side of the equation. We have a significant greater downturn where we had the Morgan Stanley Composite Index of Europe, Asia, Far East down 10.2. The emerging market MSCI Index down 12.9. Latin America in and of itself 24, over 24%. China 22, and Japan almost 11.8, almost 12%. When we see earnings, we look at them with energy. Obviously, that's a part of our economy. They were pretty flat, but without the downturn in energy, earnings actually economically were pretty good for corporations. So looking forward on our domestic stock market, we really look at a painful third quarter, but that again brings opportunity. Will the dollar still rise? We think it will for a period of time. It may hurt those large caps that are exporting goods and services to a little bit higher cost. So there's not a lot of benefit to them, but very, very favorable when it comes to valuations. We look at growth stocks in general, valuations at somewhere in that 17.2 range right now. On average, it's about 21. Technology 17.9, on average it's 26, so we've got some room to go up. Financials are pretty good. Materials are pretty good, not quite as big upside potentials there. But again, looking forward, the international side of the equation we feel is even better. It took a significant hit, sharper decline on the risk-off mentality, as we've talked about all of the relevant indices. And the dramatic sell-off in China. China was up literally 150%, backed off somewhere between 45 and 50%. Brazil over 55%, and Russia obviously, as it shows, a negative 35% from its peak. Again, creating what we believe to be opportunities. And looking ahead, there's no better place then the Latin American side of the world and the emerging. On the emerging, China is a very good place to have some of your money too. They're reforming into a consumer-based economy rather than the purchasing from everybody else. And what they have a benefit to that nobody else has, they have $3.5 trillion in reserves, where our debt to GDP ratio right now is about 100%. Europe, China, Japan, we're looking at the early stages of quantitative easing there, and the benefits we believe are going to be as great, if not greater, than the quantitative easing that we saw in the United States. In fact, during the first 4 days of the quarter here, we're looking at a almost 4%, 4.5% increase, and much of that has to do with our international exposures. Most of our international exposures are up about 8 to 12% just in 4 days. Summary then, when we look at kind of the market and its correction, it was overdue. We knew the reality of it, that it was going to happen. We just wanted to have powder dry to be able to take advantage of it, and we did, and we do. We still have a little bit we're going to put into the equation. Something of a concern for me is the investor confidence. Is it shaken? Has it been shaken too much? But I can tell you that it's nowhere close to 2008. Consumers and corporations and governments, they're all better. They're all better financially, and we can go through this downturn much easier than we did 08, 09. What it does is it creates an opportunity, and we're really challenging all of you to measure your risk tolerance. If you can take a little bit more risk, and it's wise to do that, please do that and give us a call. If you have extra cash, we just had a client in this morning. They have a $300,000 in a cash position. Said, hey, you know, double down right now. Take some of that money and make sure that you get it into the market, because you keep it in a checking account at 0.05. You know, it takes 20 years to make 1%. So let's give that an opportunity to buy low in the market today. Emerging markets we think are probably the best. You know, they were marginally positive for the quarter. We saw the Wasatch small cap that we own up almost 7%. The Van Eck that we replaced Oppenheimer with up about 3.2%. So we did have some positive things going on in the quarter, not all negative. Global markets and valuations on our page 5 of our newsletter. One of the things that we like to talk about is, you know, current events and what's driving everything. And again, I think Warren Buffett has the quote that beats all quotes, and that's when everybody's fearful, or be fearful, excuse me, when others are greedy, and be greedy when others are fearful. And we're fearful right now. That means you need to be greedy. That means you need to understand that on a PE ratio of 18.4, that means that that's the highest part of the building that you can get. If our PE ratios go to 20, we've basically had to build 2 more floors to the top of the building. But you got a lot of room to grow in China. You're on the 10th floor, right? A lot of room to grow to the 18th floor. So PE ratios are really cheap right now. Excuse me, in China in particular. Brazil with its sell-off, emerging markets in general, developed global is still better than the U.S. at 18.4. The other thing that we wanted to focus on here is just not to say, hey, we totally know what's going on, but forecasting, they have this GMO company says that the emerging markets in the next 7 years are going to be the best profitability from a total return perspective. International large cap stocks are going to be 0.8%, small caps a little bit negative internationally, and then high quality domestics a little bit positive, but a lot of negatives and not a lot of positive on the international side of the equation. We always like to have fun here at All Star Financial. One of the things that we bring from our family here is a restaurant recommendation that we have to this quarter is Snuffy's Malt Shop. I think they have 4 of them. Great malts, great malt powder. Carl Ermish got us a great family recipe of the taco hot dish. Hopefully you'll enjoy that. And one of my favorite quotes is actually an old Chinese proverb: when the winds of change blow, some people build walls, others build windmills. We want you to build a windmill. We want you to get involved. We don't want you to hide and be afraid. Now's the time to buy, and to buy low. We also want to thank you and your continued trust in the All-Star team. Remember that our referral program can help reduce your fees. And then most importantly, this is the team. We want to make sure that all the way from Bruce to Nate Gelly, intern number 94, you have the names and telephone numbers. Give us a call. Hopefully we can address your question. So again, thank you for those clients that are loyal to us and those potential clients. If I've never met you before and you've gone online to view this, we appreciate that and would love to talk to you when it's convenient. Thank you and have a great day.